Welcome to our weekly investment update. My name is Chris Marshall. I'm Head of Investment Strategy at Dragon Investment Managers, but also sit on the 75.3 Investment Committee. So as we do in these weekly investment updates, it's nice just to look back over the past few trading sessions and really pull out some of those salient stories and headlines and little snippets of market data which kind of give us an overview of what's been going on. So let's start with markets themselves. Over the past week or so, the past few trading sessions, as we head into Friday's trading session, we'll see global markets down about 2% in the equity markets. Europe has fared a little bit worse, maybe down about 4.5% on aggregate. And really we see this kind of this negative market sentiment, the channel it's been trading in, this risk-off channel, continuing for the past few weeks. Now, what's causing that? Now, of course, we saw a rapid rebound from March 23rd, and this was really when equities took the stance that the Fed or central banks around the world had started to make some significant inroads into taking away some of the tail risks of equities and financial markets. Namely, the risk that they took away was liquidity risk, making sure that the financial market themselves would just keep flowing. Now, of course, liquidity risk is one significant risk of portfolios, but there are others there, and this is where we're starting to now get the questioning of, is removing liquidity risk enough to see this through? Or do we start seeing bankruptcies and defaults, and these massive unemployment figure prints, do they become long-term unemployment, which would be a massive drag on economic activity and productivity, and then also follow through into corporate cash flows. So this is where we're seeing that the market just take a little bit of momentum off. It took a very positive and enthusiastic stance to those initial policy measures, and now really as the economic data comes through, the market is just taking a bit of a pause and really questioning, well, actually, kind of which of these sides win? Is it the central banks and fiscal policy, or is it real economic data? So let's look at some of the economic data that's come out over the past few days. Of course, UK, looking at the home market, we saw that minus 5.8% contraction in March, which was the largest contraction we've seen since the ONS series began in 1997. It was better than market consensus. Market consensus was minus 7.2, but really that consensus was probably drawn up by economists in blindfolds throwing darts at a dartboard. When we compare that to kind of then what other things we've seen coming through, so we saw Bank of England come out and say that they are forecasting a potential 14% contraction in GDP across 2020. This is a far bigger number than we've seen printed before. So IMF came out in April saying that they expect UK economy to contract minus 6.5%, which was still quite a high number there. But this Bank of England data really kind of putting a further negative slant on that. As we look around the rest of the world, of course, US has continued to see this initial jobless claims figure rise, just under 3 million again this week, and that's taken it to about 36.5 million initial jobless claims over the 8-week period of this global pandemic. And this is really kind of one of the big things of how quickly does that initial jobless claims figure turn into either long-term unemployment, or do we see those workers really brought back into the workforce? And one of the surveys done by the US Fed found that 40% of households who make less than $40,000 a year have actually lost their jobs during March. And so we see some real stresses and strains within the real economy. When we then look to other things, of course, it's not really too surprising that we see gold continuing to keep support. There are inflationary concerns if we look further down the road of just what these fiscal measures might mean. We are also seeing, of course, this long drawn-out economic weakness, as well as increasing tensions between US and China on a trade front really re-emerge. So all of those things are pretty positive for precious metals. When we then turn to oil, oil's telling a different story. We're seeing crude oil WTI index on Friday trade higher since the 3rd of April. And this is really amongst Chinese data showing that their economy, or certainly production side of the economy, is coming back quite strongly. and as the kind of social activity starts to pick up, the use of fuels for transport, cars and such like. And the oil story really kind of symbolises why we're not seeing massive sell-offs in markets, is because this is the optimistic side of the whole story, that the reopening news is very positive. Of course, we need reopenings to happen so that businesses can get back to their trade activities and can start actually having those cash flows, which really are the whole premise of what we value a company on. UK, of course, came out at the end of last week announcing this very soft easing of lockdowns. In Prime Minister Boris Johnson's words, their first careful steps. We've seen similar measures in Europe, perhaps some more aggressive easing of lockdown in Europe, certainly within Italy and Germany. Austria, of course, were one of the first of the European countries to ease their lockdown. But there does seem to be an uncommon view of how a lockdown should go. This is certainly happening within Europe, with some very, very different ideas about how that would progress, not only now in the near term, but in the longer term, of travel restrictions between borders and quarantines and such like. If we turn to the US, we actually see a little bit more of a rosy picture of reopenings. There's still a lot of interstate debate. The states are choosing their own timeframes, and perhaps rightly so. But there is a lot less restrictions on movement of people around the US, which is going to significantly help their economy versus Europe. And so if you look around the US map, you see the majority of states now planning to open over the next few days, or already taken those steps. So while we kind of look around the markets, it's fiscal and central banking policy, of course, is at the fore of everybody's thoughts and wondering where that might go next. There seems to be an acceptance or pricing into the market of some very bad economic data. Perhaps that stretches out to some very bad economic data for Q2. Perhaps what isn't in there at the moment is just the level of GDP contraction which continues through Q3 and Q4 of 2020, and perhaps also some of the longer term unemployment issues that we see going on. So how do we tackle that within our portfolios for our clients? Well, we've always had a multi-asset approach. It doesn't matter what risk level of investment portfolio you're in. So in the kind of lower risk categories, we typically use traditional funds such as with profits, or smooth funds, which aim just to try and take out some of the volatility that we see in markets, but still behind them have a multi-asset approach of mixing bonds and equities and properties and cash. When we come into risk levels 3 to 7, this is really kind of where we start to see the real performance of assets. They're not smoothed in any way as they are in the lower ones. And in this approach, we not only bring in diversity to the portfolio through different sectors and assets, but also through, of course, finding different approaches to markets, and we do that through using different fund managers. We hold 7 different fund houses with different philosophies and approaches within them. And then as you kind of get into the higher end space, of course, it's more bespoke, and that would be the picking up of discretionary fund managers such as myself at Dragon Investment Managers, as well as other national DFMs around the country. All those strategies appear to be working well in line with the risk and volatility expectations, and we continue to monitor those as we go. So from myself and everyone at 75.3, that's been our weekly investment update for Friday the 15th of May. I'd just like to take this opportunity to wish you a very happy and healthy weekend, and we will see you again next week.